Good morning, everybody, and thanks for joining us today for the February edition of the Balanced Perspective. My name is David Levinson of Ned Group Investments, and we're joined on the line from Iain Power by Iain Power, CIO of Truffle Asset Management and Portfolio Manager of the Ned Group Investments Balance Fund. I hope technology hasn't let us down, and Iain, can you hear me loud and clear?
I can hear you, Dave. Thanks. Good morning to everyone.
Great, fantastic, Iain. So before we get started, a bit of context to the Balanced Perspective. We had our first edition back in December. Everyone was on holiday in January, and we're kickstarting again now in February. The idea was to, obviously, your calendars are very full with webinars. It was going to be a 15-minute, really punchy session. We have the privilege of chatting to Iain on quite a regular basis, and he has a wonderful way of articulating a lot of the complex scenarios playing out in investment markets around the world. And we thought this was a nice way to leverage some of Iain's skill in terms of how he simplifies it for both ourselves and, of course, yourselves and your clients as well. So thanks again for joining us today. Iain, just going on to the first question. So if we look a lot, and this happened in the discussion that you had on Asset TV yesterday, was the EM trade at the moment, and there's a lot of sort of rhetoric in the market about people shifting to EM value. And then, of course, on the local front, we have Cyril Ramaphosa talking last night about loosening some of the restrictions. We had our first sort of million vaccines arrive in the country yesterday, although I think it takes a couple of weeks for them to be rolled out. I don't know, looking at these two factors in terms of the EM trade, I know the IMF has really urged South Africa to rein in their debt, as opposed to some of these EM countries that have been given a little bit more leeway or fiscal room to move. And then, of course, the rollout of the vaccine. Given these two factors, is it possible to make any assumptions of what the local equity market in South Africa might do going into 2021?
Oh, David, I think that's right. I mean, I think one probably has to take a step back to the 9th of November 2020, when the vaccine, the effectiveness of a vaccine was announced in terms of COVID. And I think that really precipitated this move of investors in terms of switching to some of the bombed out, more cyclically and economically sensitive assets. And, we saw a real substantial rally post that period in many of these markets, including emerging markets, but, also including some of the value shares, which have massively underperformed growth, certainly over the last 10 to 15 years. So, the question is, or really, are we in a position now where, with the vaccines being rolled out around the world, and perhaps South Africa going to come a little bit late to the party, as we always do, does this really mean that there could be further legs to some of these value shares and emerging markets as well, vis-a-vis some of the real sexy growth names, which really great companies have done well for investors, but frankly are fairly punchy and in terms of valuations, and we think the answer is yes. Now, having said that, we also think that there's probably going to be quite a lot of volatility and noise as vaccines are rolled out, and no doubt South Africa is going to be in a similar position and facing similar challenges in terms of distributing, managing the process. But we think by and large the world will be able to do this, and I think the US really now starting to accelerate its program, like the UK. And I think our view is by the Northern Hemisphere summer, they should be well into their own program of ramping up and inoculating all the people. And I think what this means is, it means that the earnings recovery for many of the cyclically focused companies, which depend on the economic tide coming in, prospects for those businesses will look better into the second half of this year and definitely into 2022. And I think the big positive, certainly from a Truffle point of view, is that the valuations of many of those shares are really significantly cheaper to certainly DM, as well as if you look at MSCI growth or many of the tech names. So I think everyone is saying, but isn't this a consensus view? And everyone is saying, well, emerging markets is the place to be. But really, if you look at the amount of money that investors have in emerging markets, it's still under-indexed by historical comparisons. And if investors were to get back to their median exposure, which they've had over time, which is close to about 9% odd, that would imply, another $250 odd billion of cash going into emerging markets. And, we think that as investors become more certain that governments are able to roll out vaccines and that the vaccines work, you're going to see more and more investors then start to switch and rotate out of some of the really fabulous companies, but many of these growth companies are very expensive, and that's how we've positioned the portfolio. And we started doing that into the back end of last year and continued into this year. But we wouldn't be surprised to see some volatility in the first half of the year as governments try and get on top of these vaccines. Now, from an SA context, unfortunately, we really do have a problem insofar as that we were, I guess, late to the party in terms of acquiring, and many of our other EM peers have already started rolling out the vaccine process. And I mean, it just means that South Africa's probably going to be 6 to 12 months delayed behind everyone else. So we can see a scenario into 2022 where you once again have a global synchronization of growth. And I think it's important for investors to understand what that means, because China, for all intents and purposes, has really been able to control COVID in a way in which many DM countries haven't, given the fact that they command and control the economy. And what you're going to see is the rest of the developed world is going to start to catch up to where China is, and that's going to introduce a big economic impulse into the global growth cycle towards the end of the year and into 2022. And interestingly, if one goes back to the early sort of 1920s after the Spanish flu, and once the world really got the pandemic behind them, you saw a massive boom. Now, maybe we're not going to have a similar boom to the same extent, but you can certainly see that people are going to splurge because savings levels are very high. People have saved a lot of money during this period. If you just look at savings rates as a percentage of GDP, you've got lots of fiscal stimulus that governments are pumping into the market. And we think that sets the global growth cycle up for quite a strong push into perhaps the back end of this year and into 2022. And that is generally good for emerging markets. And then obviously you've got the valuation argument where many of these emerging markets are trading at a fraction of perhaps some of the growth companies and some of the more developed market multiples.
Great, thanks, Iain. So you did mention China, and I know you have a couple of Chinese stocks in the portfolio. And we know that Truffle are a valuation-based investor in the sense you look at where an asset is trading versus what its intrinsic or fair value is. And then my question is, how do you approach the dilemma of getting teased into the global sentiment trade, moving into EM value, for example? So how do you balance getting teased into that versus sticking to your investment process? Because obviously there is money to be made on the sentiment trade, and maybe these two aren't exactly mutually exclusive.
Yeah. So I think, ultimately valuation is key in terms of the price that you pay for an asset is pretty much your most important decision that you've got to make. And typically what we like to do is we like to buy a solid business that it's going through some sort of temporary setback. And many of these EM or value focused companies are decent businesses, but the tide has just gone out because of the cycle. But the tide is now coming in, and we think that their earnings are going to normalize. In other words, their returns and returns on invested capital are going to accelerate, and then you should see that come through. So I think, at the end of the day, we go out and we look for these decent businesses, which either because of their own issues or because of the cycle have lost their way, and their earnings and valuations look attractive relative to value, and then we would start to redeploy capital into those assets. So, one is obviously always cognizant of what's happening in markets and themes and stuff. But, ultimately, it's got to stand the test of being able to access these assets at a discount or margin of safety to what the underlying intrinsic value actually is for that stock or company.
Thanks, Iain. And we know that maybe for the last sort of handful of years or 3 years or so, you've been quite late, sort of at least light in terms of SA Inc. And we had Clem Santa at our Responsible Investment Summit last week, who is the eternal optimist. And I know you have dabbled in some stocks such as Woolworths, for example, but is there any sort of SA Inc. stock which talks to that valuation-based model that you spoke of now that gets you a little bit excited every day? And then looking at some of the global sort of stocks within the portfolio, and you're probably going to ignore my WhatsApps after this because it's the cliched question, is there any single stock that really excites you and the team?
So I think from an SA perspective, we've obviously seen quite a nice re-rating of some of the SA-focused assets from post the vaccine announcement, which we were anticipating, and we were obviously well positioned for that. But there are still some opportunities and pockets in terms of value from an SA perspective. And, certainly when one looks at valuations of SA or MSCI SA, first of all, it is cheap relative to EM. And then secondly, within, I guess, a DM context, we certainly do screen very well in terms of valuation. Now, one of the caveats that one must overlay to that is the structural problems that the SA economy is facing, and many of our investors will know what we've been saying over the last couple of years, is basically that companies' ability to grow and returns on invested capital have been coming down. So, the multiples that investors will be prepared to pay will probably be lower. But now, having said this, I think it is fair to expect that as this EM trade continues to roll and investors hunt for yield, and they buy into emerging markets, South Africa and many of our stocks are going to get dragged up by this. And our valuations are not particularly expensive. So some of the sectors that we still think look fairly attractive, the healthcare sector, the insurers, some of the banks look fairly attractive. And because we're now moving through the COVID cycle, dividends are going to be reinstated for many of these companies. And when you can get a dividend yield of close to 10% on many of these shares, it means you don't need much earnings growth to get double-digit returns. So we've invested quite a bit of capital in some of these better franchises where these businesses can take market share, and where you can still get a big proportion of your return just coming from the free cash flow and the dividend, that these companies are spinning off. So yes, there are opportunities in SA, and we certainly have been, putting some money to work in some of those names that I've spoken about.
Excellent, thank you.
I think you had a question in terms of globally.
Yes.
Some of the stocks globally which look interesting. I mean, we have held, for example, a fairly chunky position in one of the biggest insurers in China called Ping An. Here you can buy a business that is, really a leader in its class. It's growing its earnings double digits. You're getting a good, 4% dividend yield, and you're paying sort of a 10 times forward multiple for this company in the context of emerging market EM, which is trading on a 16.5 forward, the S&P, which is trading on a 23 forward, and the MSCI World Growth, which is trading on a 32.5 times forward. So you're paying a fraction of the price for a business that's giving you a good yield and can grow 10%. Cigna is another name, which is we like, company listed in the US. It's a managed healthcare provider, also leader in its field, growing its earnings double digits. And once again, you're paying a forward multiple of 10 times for this business. Massive free cash flow spinning out of this business, and trading at half the price of the leader in its space, which is United Healthcare. So there are lots of opportunities still to stock pick. And Truffle, given our focus on fundamentals and valuation, we're trying to buy into these decent businesses that can give us this growth, but not exposing the capital to very high multiples, that if there is this rotation, as we expect out of many of the growth companies, that you don't potentially suffer a derating and lose some principal as the market reprices some of these real highly valued growth names.
Thanks, Iain. I mean, just talking about your fundamental approach. If we, psychologists say that often in times of high fear or anxiety, our horizon compresses in the sense we start looking at the immediate risks, and hindsight's a wonderful thing. I went back and looked at some of your fund manager workshops from a year ago, and I know your team did a lot of work on the vaccine and viruses that have happened historically throughout our history, and you made some really interesting calls in the sense there was no panic. You kind of hold on to the stocks where you still saw value, and you had that one sort of 2-3 year horizon because you knew it was going to play out this long. So I did appreciate your comments from a year ago and for sticking, I guess, to your philosophy. That is unfortunately all we have time for today. We've used our 15 minutes, which maybe almost feels like not enough. But again, please join us the first Tuesday of next month, which will be March. Can you believe it? And maybe at that point, we'll get a better sense of what's happening in terms of South Africa and the vaccine rollout, politically, what Biden's administration and their foreign policy is, particularly with regards to China. And then, of course, a military coup in Myanmar, which is quite topical at the moment. So from myself, David, and Iain, thanks again for joining us this morning.
Thanks, David, and good luck to everyone out there. Bye-bye.
Cheers.
Investing is all about finding the right balance. The Net Group Investments Balance Fund helps you to do just that. It's managed by our best-of-breed partner, Truffle Asset Management, an independent award-winning boutique fund manager. Due to their size, Truffle can make faster, more agile investment decisions than bigger, more cumbersome fund managers. With their finger on the pulse, Truffle Asset Management take risks seriously. They understand what's more important and prioritize protecting investors from the downside risk wherever possible. Their proven success lies where it counts the most, choosing the right investments at the right time and diversifying the fund appropriately in different markets. The Net Group Investments Balanced Fund isn't just another balanced fund. Due to its composition and its ability to hold a different mix of stocks, the fund offers excellent diversification benefits, making it an ideal addition to any portfolio. The results speaks for themselves. The consistent application of their robust investment process has led to peer group leading performance since the inception of the fund. That's how you know. When you invest in the Net Group Investments Balanced Fund, you're partnered with the best. Visit netgroupinvestments.com or talk to your financial planner for more information about the fund. Net Group Investments. See money differently.